Dear students, we are in module 14.3. This module I have explained the depreciation. The first two modules I used to explain the basic definition about depreciation, factors affecting nature, need, the types of depreciation, two methods of depreciation which we use in accounting. Now today we are going to continue with that. So accounting treatment for depreciation. So we will be doing two problems in this module. First thing I want to tell you that there are two methods for accounting depreciation. We are using two methods of accounting. First one is charging depreciation to asset account. So that is depreciation every year will be provided and written down value will be appearing in the books of accounts. The second one is creating provision for depreciation or accumulated depreciation account. So provision meaning you have to remember that every year whatever depreciation we will provide, they will be investing it outside. So that depreciation value will get accumulated and asset value will continue to appear at the historical cost or the original cost. So this provision for depreciation will provide funds for replacing the asset after the useful life of the asset. So these two methods are totally different. First method, charging depreciation to asset account, asset value will appear in the depreciation in the balance sheet at the written down value, and every year depreciation we will be charging to profit and loss account. It's an expense, so it will be debited to profit and loss account. Whereas creating provision for depreciation or accumulated depreciation account, whatever depreciation we are providing, we are creating a provision and we are investing outside. So outside the business organization. So that meaning when the asset has to be replaced, this value we will use to buy a new asset, but the asset value will appear in the original cost in the books of accounts. So I am going to explain this again. So just I was giving you an explanation. So the first one, charging depreciation to asset account. So which are the journal entries we have to pass? So when you are purchasing an asset account debtor to bank account or vendor account. Bank account if you are making immediate payment, vendor account if it's a credit transaction. But you have to remember that only recorded in the year of purchase. Every year we will not record because we are purchasing asset only in the first year. So there only we will record this entry, and all incidental expenses, installation charges, cost of any extra expenses we have incurred for making the machinery put to use, that will be added to the cost of machinery. Now at the end of the accounting year we have to provide depreciation, and that depreciation value we have to debit to profit and loss account. So two journal entries throughout the useful life of the asset we have to pass. One is depreciation account debtor to asset account. So that is the yearly depreciation. We know that two methods we are using, diminishing rate of return method or straight line method of depreciation. So this method, whichever method you have to work out the problem will be mentioned in the question. So accordingly you have to calculate the yearly depreciation. Now this depreciation we have to charge to profit and loss account. So profit and loss account debtor to depreciation account. So this will continue, these entries will continue throughout the useful working life of the asset. Now how this asset value will appear in the balance sheet? Already I have mentioned that asset value will appear at the net book value of the asset. Net book value meaning cost of the asset minus depreciation, or you can say that it's the written down value. So asset value will not appear at the original cost, will not appear. It will not come at the original cost. That meaning it is also known as historical cost. So this asset value will be appearing at the written down value, that is calculated using cost of the asset minus depreciation. Now the second method if you are following, creating provision for depreciation account. So as per this method, the accumulated depreciation is transferred to separate account called provision for depreciation or accumulated depreciation account. I have already mentioned this. So asset value will appear at the historical cost in the balance sheet. So both the methods are different. First one, asset value will appear at the diminishing rate. Second one, asset value will appear at the historic cost. Now accounting treatment. So purchase of asset, you have to remember that only the year of purchase only this entry will come. Asset account debtor to bank account or vendor account. Vendor account will come if it's a credit transaction. So only recorded in the year of purchase, and all incidental expenses for putting the machinery to use will be added to the machinery account or the asset account. Now at the end of the accounting year, two entries are there. Depreciation you have to charge, and profit and loss account, this depreciation has to be debited. So depreciation account debtor to provision for depreciation account. So this I told you for crediting depreciation to provision for depreciation account. So whatever depreciation you are providing, we are crediting to provision for depreciation account. Then this depreciation we are charging to profit and loss account. So the journal entry is profit and loss account debted to depreciation account for charging depreciation to profit and loss account. Now balance sheet treatment, asset will appear at the historic cost on the asset side. So asset will appear at the historic cost. So this is very important. The other one, written down value method, here it is the historic cost. So depreciation charge so far will appear in the liability side as provision for depreciation account. So two treatments are there. One is asset will appear at the original cost in the asset side, and whatever depreciation we have provided, it will appear in the liability side, provision for depreciation account. Now two problems we are doing. First one, I am going to do, Mr. A purchased a plant for rupees 5 lakh on April 1st, 2017 and spent rupees 50,000 for its installation. The salvage value of the asset after its useful life of 10 years is estimated to be rupees 10,000. Write the journal entries for 2017 and 18 and write the asset account and depreciation account for the first 3 years. Depreciation is provided as per the straight line method. I told you two methods are there, either straight line method or diminishing value method. So books of accounts are closed on 31st March every year. The firm charges depreciation to asset account. So the first method we are going to do the problem. Journal entries in the books of Mr. A. So 2017 April 1st, plant account debted to bank account because it's not a credit transaction. They made the payment by check, 5 lakhs. Same April 1st, plant account debted to bank account, being because they have spent another 50,000 for making the machinery put to use. So that is why extra expenses, plant account debted to bank account 50,000. Next is 2018 March 31st, the depreciation we had to provide. Depreciation account debtor 54,000. I have explained how we are getting 54,000 to plant account 54,000. So next is, we are charging this depreciation to profit and loss account. Profit and loss account debted to depreciation account 54,000. Now calculation of annual depreciation. See, you know that asset is purchased for 5 lakhs. Additional expenses incurred is 5,50,000. So the original cost is coming to 5,50,000. Now the salvage value or the scrap value is 10,000. So the actual value 5,40,000. And 10 years is the useful life. So 5,40,000 divided by 10, you are getting 54,000. This 54,000 will be the depreciation for this asset for 10 years. Now planned account we have to write. 2017 April 1st to bank account 5 lakh by depreciation 54,000. That is 2018 March 31st. Now in the debit side, additional expenses incurred 50,000 to bank account 50,000. So when you are balancing the account, you are getting balance 4,96,000. So you are bringing this balance to the debit side. To balance brought down 4,96,000. Now by depreciation, the same value 54,000. So now the balance in the account is 4,42,000. You are bringing it to the debit side, 4,42,000. Now again 2019 depreciation is 54,000. So by balance carried on 3,88,000. So 2020 April 1st balance in the asset account, in the plant account will be 3,88,000. Now depreciation account 2018 March 31st to plant account 54,000. Now that same depreciation you are charging to profit and loss account. So by profit and loss account 54,000. 2019 to plant account 54,000. March 31st by profit and loss account 54,000. So 2020 March 31st to plant account 54,000. 2020 March 31st by profit and loss account 54,000. So every year we will be charging the same depreciation and the same amount will be debiting to profit and loss account. Now the second problem, Mr. D purchased a machinery on credit for rupees 2 lakh on April 1st 2017 from Messrs. A Limited. He had spent rupees 10,000 for its installation. Depreciation is provided at 10% on written down value method. Prepare machinery account for the first 3 years. Books of accounts are closed on 31st March every year. So book of D Limited machinery account. 2017 April 1st to bank account 2 lakh plus additional expenses incurred 10,000 to bank account 10,000. By depreciation 21,000. I have explained how we are getting this 21,000. So by balance brought down 1,89,000. So that balance we are bringing it to the debit side. To balance brought down 1,89,000. 2019 March 31st, by depreciation 18,900. This value will reduce. The reason is its depreciation every year as per written down value method will be calculated on the written down value of the asset. The first problem, it was the straight line method. Same depreciation will repeat. So by depreciation 18,900. Now when you balance the account, you will get 1,70,100. That you are bringing it to the debit side. To balance brought down 1,70,100. Now 2020 March 31st depreciation is 17,010. So that also based on written down value method that I have explained in the next slide how we are getting these values. So when you are balancing the account, you are getting the account balance as 1,53,090. So that is the balance. Now computation of depreciation. Original cost is 2 lakh plus 10,000. 2,10,000. Less depreciation for 1 year. It is 10%. That meaning 2,10,000 into 10 by 100, 21,000. That is the depreciation for the first year. Now the written down value method you have to calculate. 2,10,000 minus 21,000. So next year depreciation will be calculated on the written down value, that is 1,89,000. Now less depreciation for the next year. 1,89,000 into 10 by 100. That is how we are getting 18,900. Now written down value method, 1,89,000 minus 18,900. So you will get written down value as 1,70,100. Now on that value 10% we will calculate depreciation. So that is 17,010. So written down value as on April 1st 2020 is 1,53,090. So this is what I want to explain in this module, and you have to give me a valuable suggestions and feedback. You have to do these problems, and the theory is also important, and 2 methods. I have explained with the help of 2 problems. So you practice the problems, then you will become an expert in the subject. And always remember that it's a scoring paper. Subscribe, promote and share my channel and help me to improve my presentation, or any feedback. You can give me a valuable feedback and suggestions. Happy learning with Dr. Alice Mani. Thank you.